Hey guys, what is up? Last day out in the mountains here in Colorado. Got a little sick, still keeping on. What a week we had last week. Time to do a quick update, going through a couple of charts and use bits that I want to share with you as we prepare for the next week. Oh man, I'm out of breath up here. All right, let's get at it. So, this crept up in my iPhone feed, and here we go. Bond yields are rising. Why that's a problem for stocks. Now, if you've been watching my previous episodes, I've been talking about bond yields rising and how it's not a good thing for stocks, and how I've been preparing and actually making some money out of that trade. And now we've hit basically mainstream media. Like this is percolated up to the top of my Apple News feed. So that tells you a couple things. One is it's becoming a real issue. What I hypothetically thought would become an issue has now become an issue. Second thing is, once it becomes something in mainstream media, everybody knows about it. So then there's a little bit of distribution of information, meaning that it won't just like crash all the way. I mean, I don't think we're going to crash out. Everybody knows about this. We're probably going to distribute and churn a little bit as people digest the reality of what I've been saying in the past couple of weeks. Trudging along, this also appeared I just had to put this in here because it just tells you how ridiculous the government is. I mean, Janet Yellen finally comes out on mainstream media and says, oh yeah, the trillions we pumped for COVID may have had something to do with prices going up. I mean, this kind of stuff actually really irritates me because it's insulting, right? It makes you feel like you're stupid, right? Like as if, how stupid do you think we are? And as I've said in my other episodes, COVID actually was the unexpected game ender for the Fed. I still believe that to be the case because until COVID hit, the Fed had been like printing money and controlling inflation since 07-08 basically. Pretty well, right? All the people who said we're going to go into hyperinflation, Peter Schiff and all those guys, while they did have a logical point to make about that, it just never happened, right? We never had inflation since all the money printing and quantitative easing until infinity since 07-08. We just never had that inflation, hyperinflation scenario that all the doomsayers were saying back then. But then COVID hit, right? And this is where I think the game changed, because after COVID hit, the world shut down. It was an unexpected thing. Bad things happened, and the Fed panicked, and they printed a ton, right? Printed like they never printed before, because they basically, were scared, right? And that triggered them to do something that they've never done before, which is to print like till really infinity, and that finally unleashed the inflation genie out of the bottle. And I think that was a game changer. And we're still, COVID was years ago, and these things take years to play out, and we're seeing the effects or ramifications of what the Fed did. So COVID was the trigger, in my opinion, of the ending of this cycle, right? It was an unexpected, outside of economic and financial market turn of events that provoked them to do something unthinkable, which is to print an absurd amount of money. And then they come out later, oh yeah, maybe it had something to do with moving along. There's a lot of other negative news hitting the headlines these days. So 2025 is starting out with a negative tilt, even in mainstream media, which sets the stage for what I do think will become a tough year for the markets. And these are, lies. I mean, there is a deflationary problem that China is facing. It's basically what Japan was facing. And now they're in this quagmire of what are they going to do? Are they going to do what Japan did and lead to the lost decade type of a scenario that Japan faced? Or are they going to do something more drastic? And I think all options on the table, which would include a geopolitical event, right? And a hot war even, or a digital war with other countries, right? To convert the economy into a wartime economy, basically what Russia did, right? But following suit. And if you don't think Xi and Putin are talking together and planning things out, you don't have a full perspective of what's really going on in the world today. Now, last week, I talked about, the bonds, the yields just going up, that we're at this really critical juncture here. It was a resistance point, earlier, and I said, this is a make or die moment. If we go over this, this is very bad news for the market, right? This is not good. And so people, in my opinion, the markets were very complacent heading into this because they saw what happened earlier when we head into it, and we got batted down and it went back down, and that caused the stock markets to rise. So similar situation, they're thinking, oh, same thing's probably going to happen. It's not a big deal. Markets were very complacent, and that's the way they were setting themselves up. But I told you I didn't think that was going to be the case, primarily because I was looking at the dollar, and the dollar, in my last episode, if you watched that one, had clearly broken out of a trading range that it had been in for over 2 years, right? So if you break out over a trading range that was going on for over 2 years, that's a massive signal. Basically in this range between 99-ish and about 100, 6-ish, and it's just been bouncing like ping pong in this range for a few years now, right? But what has happened is that we have broken through that resistance. So now we have gone above that range and about to shoot up higher. Now, this needs to be carefully monitored because it's very counterintuitive, but a strong dollar is not good. Because that happened, I told you last week that I thought bonds were probably going to do the same and follow suit, and we won't have a repeat of what happened earlier, which pretty much most of the market makers were positioning for. Well, fast forward a week, and we see we did break out of it, right? This was as of Jan 10, and we clearly broke out of this. And so that caused the market to tank again, right? Which I was positioned for, because for the reasons I said earlier. So will this go straight up? Will this be a false breakout and go back down like it kind of did the other time, where it broke out and went back down? I'm not a fortune teller. I don't know, right? It could. This could happen. It could break out and fall back down. It could. I don't know, but there are things that you can look out for to give you hints and change the probability matrix of what's going to happen. And everything's a probability game when you go into investing, right? And so you play the good probabilities, and over time, if you keep doing that, you're going to make money, right? So what happened last time? We broke out, we tested the resistance, but it failed to hold. We went all the way down, we went up, and then broke down again. Basically, what was resistance failed to hold as support 2 times in the previous incarnation when it went up and down. Here, we couldn't even break resistance. Here, we broke resistance. So the question now becomes, are we going to go back down and retest what was resistance to become support? And that's exactly what we should be looking out for over here. Are we going to go up and finally go back down and test what was the resistance point, and will it convert into a support point? That is what I'm watching in a couple of weeks, and that'll give me an update to my probability matrix of how I'm going to position myself to make some cash. My sense is, I do think in this time, we will eventually go back down to test the previous resistance, and I do think this time it will act as support. And if it does, I'm going to further position myself to make more cash. So moving along, so that's basically the yields, right? Look, we've broken out. Now we're looking to see how far we're going to break out and whether or not this is a false fake out move or not. All right, so moving along here, I just wanted to make a mention here. We can't just look at the United States in a microcosm, because the bond market, which is essentially a global market for all the economies around the world and their central banks, is still fully integrated with each other, right? The Japanese, and this goes back to the whole yen carry trade unwind. Remember when the market had a flash crash late last year? Well, if you look at what the Bank of Japan is, it is deviating from the rest, right? And this continues, right? And this is something we should continue to watch, because this could be a potential trigger point, or in addition to another trigger point, to really exacerbate the bond yield problem that is festering in the global central bank bond markets. And so this deviation is not good, right? This is something to closely monitor. And I've been closely monitoring ever since I've been talking about the yen carry trade unwind last year. If you look at what's going on in the UK, same thing, right? This doesn't look too dissimilar from what's going in the US. Jan 7, we're hitting, we've broken this. I mean, look, the bottom line is yields are going up across the board. That is not a good sign. Then the sister to this is what's going on in the currency markets. These are huge markets. Currency market, the equity market, where the dumb money sits. I mean, that's a smaller market, but it's where we make money because it's easy to get in and out. We don't have to be professional traders to trade government bond yields and currencies. I mean, you could, but most of us don't, right? Because you need volume to make money, and we don't have that kind of millions and billions of dollars of volumes to trade with. So yeah, this is a global thing going on. So moving along, I keep talking about this, but I like to give you different snapshots of the same thing. And so here's yet another snapshot of the same thing, which is we are very concentrated, right? This is not good. Whenever the stock market is super concentrated into just a few stocks, bad things happen. And we are here now, right? As of the end of last year, look at that, right? Look at that. I mean, today's AT&T, GMX, and IBM Texaco is Apple, NVIDIA. But the last time it was concentrated like this was in the 64 and 20. We are going to have a mean reversion where it's going to get more evenly distributed and normalized again. And when that happens, we're going to have a massive correction, right? Make no mistake. This does not sustain forever. No way. This stuff does not sustain forever. It will have a mean reversion. It will have a mean reversion. Mean reversion means we're going to have a repricing of basically the rest of basically the top markets, which control, influence of most of the index, which means the index will be going down. Now, last week I saw something that I wanted to talk about with you. There's a lot of stuff out there where it's like, oh, look at what happened in 19 blah, 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 and we're following it, so the same thing's going to happen again. And, well, everybody has a brouhaha, and there's a lot of clicks on it. And one of the most often pointed out one is, oh, well, look, we're following the Roaring '20s, and we're going to have the Great Depression after this massive crash. That story has been, played out so many times. And it's been played out again by Bravo's research over here. So I'll be showing a couple of their charts here. But I bring this one up because unlike most of the other ones, this one I do find, even if the whole thing about it doesn't, history rhymes, it doesn't repeat thing. I do think that there is this rhyming thing going on here. And so let's take a look at this. The time frame is by years. So keep in mind, right? This is decades, right? We're talking about decades time frame, so you can't go by a month or a week or and saying oh, this isn't going to work or this is going to work. You got to keep looking at it at a yearly time frame at the minimum, right? So keep that in mind as we go through this. But we are kind of tracking the Roaring '20s, right? Peak, heading into a peak. Will we go up there or shoot farther or not get up? I don't know, right? But this activity where we had 2 cycles and corrections and then this massive upturn, really stretching the rubber band as far as it can go, does kind of mimic what happened in the 20s, right? So, if you take this one step further here, we did have, the dot-com bust, then the 07-08 recession, about 50, actually it's more than 50, 60%, but whatever, about half crash, and then we just freaking went, there was a little COVID spike, didn't last long. It was like a record break. This was actually really scary. It was worse than what happened in 1928, 29. But yeah, we did have these 2 pretty significant corrections in this time period before we started going up. And if you look at what happened in the 1900s, we did have a similar correction, right? Before 1920 and then right at 1920, 21, before we did have this huge run up for many years until the major crash happened, right, in 28, 29. And if we look a little bit further, that crash was, that was a heck of a crash. Now, are we going to have this kind of a crash? I don't know, right? Chances are probably not. We have things in place today that they didn't, right? First, we have circuit breakers now, so the markets can't just collapse forever. The markets will shut down. Then we created things such as a Federal Deposit Insurance Corp. So, you can't have bank runs, or supposedly. We saw what happened in Silicon Bank. The Fed basically came and backstopped every single bank. So screw the FDIC. We're just going to print money and make everybody whole again. So will this happen with those new, financial machineries implemented since that? I don't know, probably not if you ask me. But will we have a severe or serious correction? We could, right? And that's what I'm preparing for. And the reason why we could is because, whenever you stretch yourself, and you change the business cycle, like, it should be like this, right? But you fudge around with it synthetically by creating cash, lowering interest rates, having negative real interest rates, doing quantitative easing till infinity, like doing all this crazy money printing stuff, basically, right? And you do it for so long that some people are deluded to think that we'll never have a recession again, or the economy goes only one way from here till infinity, till the end of time. It'll only go up ever, and we will never ever have a recession. When people start thinking that, that's when like you've really stretched the rubber band so far up. Man, my voice is hoarse from my sickness, so apologies for that. But when you stretch it to the point where people actually start believing such crazy Kool-Aid that they've kind of defeated gravity somehow, there's going to be a correction, because you can't stretch the rubber band and when you let go, like pretend to have it be a slow, mean reversion, right? That's not the way anything works, whether it's physics or economics, it doesn't matter. For that reason, I do think, look, we're going to have a pretty serious correction, and it could be that it starts this year, right? So let's talk a little bit about how I'm positioned with the stock markets and how I'm making money on this. And you guys who have been following me, you know how I've been making money, because I tell you what I've been doing. And you can verify that, right? So you know that I'm not lying about how I'm actually profiting and not actually just talking out of my behind over here. But if you look at this moment, so this moment, right, was when we had that pretty significant downturn, mini flash crash, as we will. This was on December 19, when basically the Fed did lower interest rates by 0.25 BPS. And that didn't do much to the stock market, but it was when Powell came out and talked, and they kind of were hawkish, right? Saying we're not going to, in the future, we might not lower as much as we think we will. That's when things really, and so you had two gigantic down bars, hourly bars, this is on an hourly time frame, after that, on huge volume, right? Look at the volume over here. That to me was the signal. That was the moment where things shifted, right? Right there, right here. And so at that point, I changed my configuration and plan to position myself to make money on a downturn of the market, primarily being long volatility. And so, we did have some upturns and, some big bars, but on lower volume, but generally we've been going down since then. So let's take a look a little bit in the markets, and I'm going to show you actually, I'm going to zoom out from the monthly into basically even to the 5-minute. So on the markets, you can see what I'm looking at. This is on the monthly time frame. So since 2018, all right, I got my doggies. Hey, guys. All right, so the doggies are out in the snow now, but let's take a look here. And I'm going to run through my thinking on the market, starting with the monthly time frame. So on the monthly scale, going back to 2016-ish over here, we see we've made a pretty significant run up. And what I'm looking out here is the MACD is about to curl over and cross over, right? Once this happens, that'll be the definitive, for me at least, that we have started the bear market. We're not there yet, clearly, right? Because we started curling over, which is when I started making money in downturns, but we're not fully there yet. So I've been pretty cautious and positioned myself actually to make more money as we continue to make new all-time highs. So I make money going down, but also make money going up right now, because I do think we're not there yet, right? So new all-time highs, good, I'm making money. I'm not saying market is going to crash and that's it, even if I do make money in both ways. But the point here is it's beginning, right? It's beginning. And now when the crossover happens last time it happened around here, you'll know, right? Then I'll be significantly bearish rather, in terms of my positioning. So that's what I'm looking at. The RSI, if you look at this, is continue to go down. We may make a new all-time high, I'm thinking, if we're lucky, right? And have a lower RSI and have a divergence like we did over here. And then that would be it. could this happen where we go through, this could happen as well, where like we go down for like half the year and then next half the year we go back up and make a divergence like this. That is possible too. I think it's on the lower end of the probability, but like again, I'm not a fortune teller, right? That's not the point here. The point here is to observe the market, calibrate your risk positions and make money accordingly. So let's go into the weeklies, right? And you see these horizontal lines, these are key support and resistance zones. So like I'm looking for these things to get triggered over time because I do think we're going into a bear market. So I'm just waiting for us, how we're going to get there. I don't know the time it's going to take. So it's not timing the market or timing the market like people say. It's actually just having your price targets and let the time take itself to hit them, right? That's the way to do it. Not timing or time in the market. Now, time in the market works if you've got like a 20-year time frame and you're just leaving it there. And equities tend to go up over time, although there are these rocky periods like Japan. If you left your money in the equity market, 30 years it took you to come even again, so you don't want that either. Now, if we go into the weekly over here, on the weekly, it gets a little more grim because on the RSI, we're having whole lot of negative diversions on the RSI. So on the weekly, it's kind of already started, right? It's kind of already started. And we've already curled over here. So in the weekly time frame, I'm more bearish. In the monthly, not yet, right? And you have to know how to manage your time frames here. But on the weekly, yeah, I am more bearish because of this. I mean, it's clearly negative divergence happening. And with the last, since the year began, drops here, no question, right? No question. So here, potentially, here, after some bounce, and possibly here, before a significant run up, right? Whether we get to here in this run, I don't know. Here, possibly, something we'll have to monitor, but these are my price targets that I'm carefully monitoring. Now, going into the hourly, now, if you were looking at, if you were watching me last week, sorry, my head's freaking gone from my flu and the light oxygen up here. But I can't seem to, why can't I decrease? I can't decrease over here. Okay, let's go back to the weekly so you can see it. But basically on the weekly, what I was showing you last was I said that there was this descending triangle forming, right? Right at the top over here. We kept making lower highs and kind of been holding a horizontal support. So there was this descending triangle, and those tend to resolve to the downside. So I was looking very carefully. I said throughout the week, hey, is this descending triangle continuing to form? And will we break the bottom? Well, I positioned myself that we would at least test the bottom and perhaps break it. It's going to be a couple of weeks ago. That's the part where we don't know. That's why I go into shorter time frames. And in the shorter time frames, what do we see? We see this pattern emerging. So something I'm closely watching. As of now, I just left my long volatility play. I also went short the Russell 2000 with a smaller point, just to mix it up a little bit. So I'm net short right now, and because I did make quite a good amount of profit earlier, I have buffer to lose out. Even if the stock market goes up, I'll still be up net. So I have wiggle room, and I don't want to basically miss the next move down, which could be a pretty strong move down. So that risk of it going up here, it's okay. I can stomach that because I made profits. Now, if it goes up here and it blasts through it up here, I might close my positions and flip long and try to go for a ride up to the new all-time high. And then from there, we see we're a good entry point to position yourself for the correction and possibly a topping correction in the coming week. And that's exactly what happened, right? Hit a high, went back down, hit another lower high, went back down, hit another lower high, went back down. So last week, I was playing this on the hourly, right? And positioning myself long volatility with a little bit of short Russell 2000, as I said. Now, what happened was I said, look, if we do break down this descending triangle, you have to be very careful because it could be a bear fake out, meaning it would break down and just shoot the heck right back up and kill all the bears, right? So I was very carefully watching this, even as I was making a lot of profit on long volatility as this thing was going down with my UVXY position. I was very careful because I didn't want to get lured into a bear trap and lose all the profits I had made. Then it would just be unrealized gains, right? And so we did break down, and we broke down, and lo and behold, let's zoom in, we stopped and went back up. So it was at that point, right, actually on Friday, where I was kind of, concerned. I was like, wow, is this going to go all the way back up? So what I did was over here, I actually cashed out some of my profits, right? It's like, hey, if you made money, right? And my profits was over 11%, which is not bad to make 11% in a week, right? That's pretty good. So I cashed about 30% of it out right around at this bottom once I saw it bottoming up and going up. And I left the rest in to see what would happen up here, because what would happen sometimes is you would come back and retest the bottom of the horizontal line and see if that holds or not. And if it holds, meaning its resistance, then it'll come back down. If it doesn't hold and it breaks through and continues up, then it was clearly a false breakdown and a bear trap, and time to get out, right? Well, it went up, and I was carefully watching it. It was hitting the EMA here, and it went back down on volume. Look, on volume, right? That's a lot of volume over there. And went back down on volume. So I said, look, looks like it broke down, retested, and failed the retest, and broke down again on much more volume than when it was going up. So more sellers, right, pushing the pricing down. So I left the rest in. So now I'm 30% cash and 70% still in my UVXY over the weekend. See what'll happen next week. So what does that mean? Well, I don't know, man. Basically, you got to go into the daily. Oh, I missed the daily. No wonder you couldn't see it. I was looking at the weekly. Yeah, so in the daily, you see it a little bit more clearly here. So yeah, so here's the descending triangle, right? And we crashed through it. We went up and broke down. So what does that mean on next week? Well, I'm looking for it to good chance to hit this resistance point, right? About 57.20. Think about going here, and then I might be careful again and see what to do here. It's also a support line for the channel, right, that it has been in since, like August of last year. So this is a long rising channel. The bottom channel coincides with this support. So it could be that we bounce off here, and that's probably where I might take some more profits. If we just like Korean and crash down all the way, I'm keeping in obviously, but this is an area of interest I'm watching for the next week. So having said that, I gotta make do with, I'm heading back to the East Coast and then back to Singapore and possibly Bali. So a couple of long flights ahead of me, but see what happens, right? And I'll see you next week, probably from the other side of the world over in Asia. But no matter where we are, we keep doing what we're doing, which is watching the stock markets, being smart about knowing what to see and positioning yourself to make money, no matter where you are in the world, whether it be here or there, what time doesn't matter. That's the beauty of having your own business and income generation stream doing this. Till the next time, I'll see you. Peace.